Welcome back to Battle Tuesday. Edwin's here with you while the crypto market is up, down, or sideways. Here, I'm gonna show you in real time my real portfolio, and you can double check on Revert on Debank. And I'm gonna walk you through my thinking process. So for those of you who are new to the crypto market, and you can follow me through the step-by-step process. And my goal right here is to make you money. If I'm not making you money, you don't have to watch this channel. So for the past couple weeks, crypto rally has been going through a crazy rally. And my portfolio specifically, even though I only deployed 40% of my position in the active market, among which 20% is in DeFi, another 20% is in an equity investment with dividend payout. My portfolio specifically, it went up by $500 with just 40% deployment. And I only deployed it 2 days before for my DeFi position, and my equity position, it was up months and months before. We're going to talk about it later. But first, I'm really excited to talk about the DeFi positions and how you can use DeFi positions to hedge against future market downturns. So right here, I am going to open 2 tabs, and these 2 tabs are going to really illustrate the spirit of how Defi LP can hedge against your portfolio downturn. When we look at this graph right here, these are all the hold values, means my crypto position benchmarking against if I hold these cryptos. And these are pretty vanilla products like Ethereum, Bitcoin, and other ones, SNX. They're the largest synthetics platform on Ethereum, and they're starting on Optimism. I think they're great. We're gonna take a deeper look right here. But the gist of this is that right here, this baby average a 132% APR. And for this another more volatile asset, SNX, this averaged a 300% APR. And when you take a deeper look at this, the position fees, I made all these money, and these money are gonna hedge against my portfolio downturn. What I mean by that, if I put all these values as USD, as you can see, I made $60 on this position. I made $16 on this position. Considering that I only deployed it 2 days ago, this metric is very impressive. But however, if this metric goes down, this PNL goes down, I'm going to take a huge loss. In order to hedge against that loss while maintaining my long position, I can use the LP fees, which average me $3 a day. And I can use this fee to hedge against the potential loss from me longing these 2 assets, which are Ethereum and Bitcoin. And one thing interesting right here is that for the more stable asset, Ethereum, Bitcoin, we average a 30-day period of concentrated liquidity pool without changing the pool position. However, when you look at SNX, this only average a 15 days because SNX in nature is more volatile. It is not as blue chip as Ethereum and Bitcoin. Now, why did I deploy them 2 days and 2 days ago? Because I saw the rally. But why did I came into the rally? And this comes back to the Econ data. These are all the data we're going to touch today, just like how an institutional investor coming from the TradFi will analyze this data. First of all, the FOMC Meeting rates, federal funds effective rates. This is the most important metrics in macro, and they have been stable for the past couple months, and that's why you see people have more money to load on risky assets like equity investments, S&P 500, NASDAQ. Among the most risky asset among all these are the crypto assets. And that's why you saw this rally in the crypto asset area. Number 2, we're going to look at what Feds want to do. They want to do dual mandate. They want to maximum unemployment and keep inflation rate at 2% target rate. And let's take a look at how they're doing with their 2%, 3.2. So that is doing fantastically well compared to the June level, which is 9%. And if you remember, in June, there was this little rally lasting for like 15 days because there is a marginal change from 9.1% to all the way down. In economics, if you have this marginal change, no matter how big it is always better than you change it on a quantitative level, because the derivative, the marginal change, is the key driver of market expectation. Take another look at this unemployment data. This is a bad baby. Look at this. It was tumbling around 3.5, and now it's at 3.8. So the worse the unemployment data, the more likely Fed is going to cut rate. If Fed cuts rate, people are gonna have money to load on a risky asset. If people have more money to load on a risky asset, people are gonna invest in Bitcoin and Ethereum, and that's why you see when the traders on Wall Street, when they're betting that rate is gonna get cut, risky asset like equity investment and Ethereum, Bitcoin are going up. So risky assets, equity, and Bitcoin. And what is our counterpart? Our counterpart is the risk-free asset. The money that you just put your money in and then just prints out money with zero risk. And who is the most badass boy right here? It is called the US government. They issue all these 10-year treasury notes at very, very cheap funding rates. And right now, their funding rate is 4.1%. And when you take a look at this, around October rates had a dramatic shift from climbing up to going down. And that is a huge marginal change. And that's why you saw the start point of this rally. When we saw the risk-free rate of 10-year treasury note coming down from 4.8 to 4.1, people are getting more money because you are putting money in risk-free assets like treasury notes. It just prints out free money. But that free money is getting smaller and smaller. So you want an alternative asset that drives higher return. And what do? You load on risk. Let's take a look at this 5-day graph. You see this metric is going down, and that's why I saw this crypto market is going up, down, but the trend is still going up because the risk-free rate, the trend is still going down. And that is how traditional investors look at a risky asset like Bitcoin and Ethereum. Two most important Econ data update that we found for the past 2 months, why this rate is going down. Two things. A month ago, Treasury, they just increased auction for just a little bit. Just you see this little tiny increase right here. That little tiny amount is enough to drive the Treasury rates down. And that's all you need to jack the price up. Secondly, December 5th, you're going to see the market was down a little bit before 10 a.m. Eastern Standard Time. And that's because the market is betting job opening data is going to look good. But in reality, it looks pretty bad. As you can see, it is below all expectations. When you take a look at this, job openings, it is getting harder and harder to get a job. And that's why when this data, which was released at 10 a.m., the market is pricing it as a good indicator for Fed to cut rates in the next FOMC meeting, which is next Tuesday. And for the unemployment data, it's going to come out this Friday. The unemployment data this Friday, the job opening data today, and another inflation data, which coincidentally comes out as FOMC, so that doesn't really take into account. So these two data really going to drive the FOMC meeting here. And the market is pricing either we're having the rate to be stable or we're going to have our first rate cut in the first quarter 2024. And that's why you saw a risky asset like Bitcoin, Ethereum is going up during this turmoil time. Let's take a look at this crypto data, which I found insane. And this is why I only keep 40% of my portfolio in risk asset. I keep another 60% on fiat positions, aka DAI, DAI. You take a look at this, fear and greed. You know, Warren Buffett said, when people are greedy, I'm fearful. When people are fearful, I'm greedy. And now we are just really, really greedy right here. You take a look at this. Green means we're greedy. And for the past few market cycles, you really notice this greedy pattern is not sustainable. It's going to come down. And that's why I only got 40% in risk asset. Among them, only 20% in equity investment. Another 20% is in DeFi positions that drive stable, sustainable dividend to me, which average APR of 144 and 342%. You look at this graph, you might wonder why this is out of range, but I'm doing absolutely nothing. Because Ethereum and SNX, they are positively correlated. It means one lever can go up and the other one is probably going to follow. And right here, I am betting that the levers are going to follow each other. And this is it. I hope you learned a lot and hope to see you next time.